Good day, ladies and gentlemen, and welcome to the Q2 FY23 earnings conference call of Aptus Value Housing Finance Limited, hosted by Dolat Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Mona Khetan from Dolat Capital. Thank you, and over to you, ma'am.
Thanks, Michelle. Good evening, everyone, and welcome to the earnings call of Aptus Value Housing Limited to discuss its Q2 FY23 performance. We have with us the senior management from Aptus to share industry and business updates. I would now like to hand over the call to Mr. Anandan for his opening remarks, post which we can open the floor for Q&A. Thank you, and over to you, sir.
Thank you, Mona. Ladies and gentlemen, good afternoon to all of you. I am Anandan, CMD of the company. I welcome you all to this conference call to discuss the financial performance for the quarter ended, half year ended, FY23. I have with me Mr. P. Balaji, ED and CFO, and Mr. C.T. Manoharan, Executive Vice President, Business Development. The results and the investor presentations are available on the stock exchanges as well as on our website. I hope everyone had a chance to look at it. Aptus, as you know, had a healthy first half year, so reflected in our strong financial results. Disbursements growth has picked up momentum and collections are back to pre-COVID levels. With focused collection efforts, 30 plus DPD sharply improved to come down to about 6.32% from something around 12.98 in March 22, then 9.9 in June, and now it is 6.32. Achieving, in fact, these levels we are able to achieve even sooner than what we have expected. Coupled with this improvement, there is good improvement in NPA and our NPA as well, which has improved to 1.47% as against 1.75% as on 30th June 22. Total disbursements for the half year stood at 1,129 crores as against rupees 668 crores in FY, in the first half FY23, FY22, up by about 69%. AUM as on 30th September, it's closer to about 6,000 crores, 5,932, which represents a healthy growth of 33% YOY. NIM for the year been very healthy at about 14.02%, representing an improvement of 129 basis points as compared with previous year. We have registered an ROA of about 8.7%, which is one of the best in the industry, and an ROE of 15.83%. I would like to reiterate the fact that we have enough balance sheet liquidity. Currently, we are carrying about 1,000 crores of cash and cash equivalent and deposits. Liquidity without, in fact, this 1,000 crores does not include undrawn sanction of rupees 500 crores from National Housing Bank. Our net worth stands at about 3,175 crores, which indicates robust capital adequacy in order to support the future growth. Key highlights for the half year 23 performance being our NII was about 405 crores, up by 45%, and NIM 14.32, up by 129 basis points. And net profit about 242 crores, up by about 52%. And AUM is up by about 33% at 5,932 crores. Disbursements for the first half year, as I mentioned earlier, about 1,129 crores, a growth of 29%. And GNPA is about 1.47%. Capital adequacy is about 80%. And our ROA, as I mentioned, about 8.7, one of the best in the industry. And ROE is about 15.8. In fact, there is an improvement, increase of about 174 basis points in our ROE compared with the previous year period. I would now hand over the line to Mr. P. Balaji, our CFO, to discuss various business parameters. Thank you.
Thank you, sir. Good afternoon, all of you. As of 30th September, the total live customers were over 95,000. It represents a growth of 31% year on year. Total number of branches were at 213. We have added 5 branches during the half year. Employee count was at 2,359. Main performance highlights were AUM grew by 33% year on year to 5,932 crores, and disbursements increased by 69% to 1,129 crores as compared with the corresponding half year last year. NIM was at 14.32%. It was increased by 1.29%. OPEX to assets were at 2.77%. PAT was at 242 crores, representing a growth of 52% year on year. ROA and ROE was at 8.71% and 15.83% respectively. Now coming to the asset quality, with focused collection efforts, 30 plus DPD sharply improved to 6.32% in September versus 9.91% in March and 12.98% in December 21. Coupled with this, there is a good improvement in our GNPA to 1.47% from 1.75% as of June. Net NPA is at 1.1%. We have increased the provision coverage ratio from 0.8% in March to 1.01% as of 30th September. We are carrying a total provision of 60 crores, and this, when compared as a percentage of NPA, works out to a coverage of 69%. Outstanding restructuring book were at a nominal 0.8% of the total loan book, and the behavior of this book is on par with our normal book. Borrowings, we have well diversified borrowings. 64% of our total borrowings are from banks, 21% from NHB, 10% from DFIs like IFC and large financial institutions, and the balance is in the form of securitization. We enjoy a rating of AA minus both from ICRA and CARE. We have sufficient on-balance sheet liquidity of 1,000 crores without including the undrawn sanctions of 500 crores from NHB. As on 30th September, our net worth was at 3,175 crores. Thank you all. Now, with these remarks, I open the floor to the for the question and answer session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may please press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, sir. Good afternoon. Thank you for the opportunity. Couple of questions, sir. One is, just want to understand what are these quasi home loans? What is the definition of these? What is the ticket size? And what are these insurance loans? My understanding is
your voice is not clear. We are not able to.
Voice is not clear.
May we request, Mr. Mishra, may we request you to please use your handset if possible?
Hi, is this clear?
Please proceed.
Yeah. So I wanted to understand the definition of these quasi home loans and the average ticket size for these quasi home loans, sir. And my understanding is that we can't provide a loan for insurance attachment. We have shown something as 4% as insurance loans. So if you can clarify on that. And wanted to understand what proportion of our bank borrowings are on EBLR. These are my few questions. Thanks.
Yeah. First, in terms of the quasi-home loans, actually they are home loans requested to construct the homes. So they are home loans only. But only thing is that they doesn't qualify the full interpretation of NHB as a home loan because they were constructed, the completion was done about few months back, or such other things. So in other words, they, for all practical purposes, they are new homes, and the customer builds them for self-occupation purpose. And had they really planned in advance, they would have been very much qualified for HL. But since they really, most of our customers are really self-employed customers, and land is owned by them. Construction costs also largely incurred by them. But when it comes to part of the construction cost, they don't request for it in time, much earlier than actually what they need, resulting in these loans are given after completion of the construction, after a few months and things like that, which doesn't qualify as HL. But from our point of view, they are good loans, the loans for good customers, and we are really treating them as quasi-home loans outside the definition of HL as defined by the NHB. That's on the quasi loans. As far as insurance is concerned, actually this is not insurance. This is an insurance. I mean, this is more of a credit shield, insurance premium paid for the credit shield in case of unfortunate event happening to a customer. Then the outstanding loan liability is paid by the insurance company, as you are aware. These are very much permitted. So we are giving a loan, equivalent to that insurance premium, credit shield insurance premium, and that works out about 3 to 4% of the loans. And this is very much permissible by the regulator. Only thing, it cannot be qualified. It doesn't qualify. You can't classify it as part of the HL. You can treat it as a non-HL loan. So that's on the insurance. For the bank one,
what is the borrowing percentage linked to the MCLR of bank?
Yeah, actually, our, if you really look at it, our balance sheet size alone, total funding of about 6,000 crores, closer to about 3,000 crores is really our net worth, and the balance 3,000 crores, it's really, it is really the bank borrowings. Of the 3,000 crores, 60%, about 1,800 crores is the bank borrowing, is the fixed rate, and the balance is variable rate. And this variable rate is linked to the 1-year MCLR rate. So in other words, there is some, as far as the, company is concerned, while there is substantial increase in the interest rate, the impact on it is somewhat, less, given the fact that our leverage is low, A. B is that on the borrowed funds, significant part of our funds are really fixed loans for a period of 5 years and above. And of the balance borrowed money also, the variable part, the interest rate is linked to MCLR on a 1-year basis, so there is a lag impact. So that way, at least for the year ending March 23, we don't expect, we expect our existing, funding costs to continue.
Right, sir. And what is the average ticket size on quasi-home loans, sir?
It is about same actually. Our home loans, as you are aware, it will be in the average of about 8 to 9 lakhs of rupees, and the quasi-home loans also are around that only. As I mentioned, it is home loans for all practical purposes, but it doesn't meet fully the requirements of energy. That's it.
Sure, sir. Thank you for your time. I'll get back in the queue.
Thank you. We have the next question from the line of Ankit Bansal from EB Investment. Please go ahead.
Hello.
Yes,
Hello.
Ankit.
Yeah, sir, my question. My question is, sir, if the finance cost and the employee cost have increased in this quarter, can you please explain what are the reasons, sir? Is the interest rate increasing? That is the reason, or can you please explain?
Yeah, actually, the interest cost percentage terms, it has not increased at all. It has increased because of the incremental disbursements came out of borrowing, and to improve our, as you know, that will improve our leverage. So, in other words, the increased finance cost is an account of the additional borrowing coming to support the additional disbursements. We have mentioned that in the current year we have disbursed for 6 months, we disbursed about 1,200 odd crores. Almost entire 1,200 crores came out of borrowing. The equity has been fully utilized even at the opening level. So in other words, interest cost per se in percentage terms is not so much increased. In fact, it's about same or marginal reduction. But then what has really increased cost in absolute terms is gone up because of the additional borrowing to support the additional disbursements. That's one. On the OPEX also, if you see, first of all, the OPEX last year, was 5 months because April 21, as you know, was sort of fully closed on account of COVID. Current year is really 6 months. So it is 5 versus 6 months comparison. But apart from that, there is some increase in OPEX, mainly in the employee-related costs. That too, the variable component of the employee-related cost to support the significant growth in our disbursements in the first half year.
Okay. Sir, the next question is, sir, what performance in new markets like Odisha, Maharashtra, where you just started? How it's been going? As
part of our, growth, we always been working on few things. One is really increase the productivity, enhance the productivity of our existing branches, existing staff, and then add the new branches in the existing stage, then add the new branches in the new stage. The first one in terms of the increase in the productivity of existing branches, existing staff is going on well. And we are adding the new branches in the existing states, namely particularly in Andhra and Telangana. We did add quite a few branches in the last 12 months or so. And the third element that you are asking in terms of adding new branches and new states, we believe in this philosophy of contiguous growth. To that extent, we are looking at Maharashtra, Odisha, and Chhattisgarh. And the first step, we have really started. We have opened one branch in Maharashtra and Dharampur, and there are plans to open. Second branch also will be open anytime now. So we will be looking at closely Maharashtra and and Odisha going forward.
Okay, sir. Any idea of giving dividends, sir? Your shareholders are waiting for this.
The board will take the call as appropriate, in time. Yes.
Sir, we are loyal shareholders, sir. We have been with Aptus from the IPO, sir. Please consider this requirement.
Yeah, noted. Thank you.
Noted. Thank you very much.
Thank you. We have the next question from the line of Rishikesh Bakri from Leapfrog Investments. Please go ahead.
Yeah, sir, just wanted some clarification on definitions. So, for example, there is a sanction TAT of 72 hours, which is mentioned there. So, what does it include? And is it like end-to-end from login to sanction, or are there parts to it which you don't consider in this TAT definition?
It is basically the login to sanction. From the time the files are logged in at the branches, the sanction happens at the head office. That is within 72 hours. But what happens, the final disbursement, the kind of segment which we are servicing, basically the self-employed kind, they might not have the full legal papers on hand. So it takes time for them to have the legal documents given to us, and then it takes time for us to vet the documents. So that takes around 7 to 8 days. So after that, the disbursement happens, but the sanction happens within 72 hours.
Okay, sir. Thank you so much. Sir, just on your asset rundown, what are your current BT out rates like?
Actually, our total, if you really see the balance transfer to the other financial institutions, including banks and HFCs, it is only about 2.5 to 3% only. But in addition to that, there is another 5% is coming. It's not a BT. The R type of customers who are largely self-employed, over time, they accumulate savings through local chits like Shira, Margadarshi, etc. And using the funds or other funds, they come for the pre-closure of the loan with their own money. So it is not really BT, but from our point of view, it is a pre-closure. So pre-closure, overall, it is about around 8%. But of that 8%, further split, if you look at it, 5% is out of customer own money, and 3% is really the balance transfer to others. In fact, we also have the habit of, as a process, we check through these customers who really settle their account through their own funds after 6 months, after 12 months, to see whether they have taken the loans anywhere else, and they have not taken the loan also. So they have kept the property free. So which means that it is confirming our view that it is out of their own money.
Oh, it's excellent. So, sir, just to confirm, these are annual numbers, right? 8% annually in terms of rundown and
yes,
BT being only.
This is the percentage on the. Normally, we compute the percentage on the opening stock on on lending. On AUM, let's say on the 1st of April 22, we take, and that we compare with with the actual pre-closures during the year.
Understood, sir. No, excellent. Just one last question from me, sir. On your asset side, so liability side, you've given a fixed and variable mix. On the asset side, I see that. What percentage of your books are under fixed rate which you cannot reprice, and what is flexible? I see some numbers in the presentation. Is that the right way to look at it?
Yeah, in the loan book, 78% of our loans are on a fixed rate contract basis, and only 22% is really on the variable contract basis. So, but having said that, on the liability side also, we got significant part of it on the fixed, either equity or the fixed loans, and the variable part of the loans are really around 28% or so. On the liability side, and the asset side is about 22%. But then, we are also able to bring down our, some of our borrowing costs, leveraging our credit rating upgrade done in the month of December. And also, going forward, we will also, we are planning to use the undrawn 500 crores from the NHB, which normally provided at a lower interest rate for a much longer tenor.
Okay, sir. So just to confirm, so on the 78% fixed, you don't have any ability to reprice. And is this ratio staying constant for your fresh onboarding, your current disbursements also in similar proportion?
Yeah, see, it's not a question of actually our contract does provide, in case of exceptional situation, we have the right to revise the interest rates even on the fixed rate contracts. That clause we never invoked in the last 12 years.
Understood, sir. Excellent. No, congratulations for a very good quarter, sir, and all the best. Thank you. That's all from me.
Thanks.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to answer questions from all participants, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. We have the next question from the line of Pranav Gupta from ASK Investment Managers. Please go ahead.
Yeah, hi, am I audible?
Please proceed.
Yeah, hi. Firstly, just a clarification. Did you say 70% of the loans are on the asset side are fixed?
Yes.
Okay. So two questions from my end. One is on the employee costs. So if you look at it on a sequential or YOY basis, on both the counts, there's been a significant jump. Could you explain if there is any one-off here or whether this is the sort of run rate that we're looking at, given that we are expanding into new geographies? That is the first question.
See, first of all, I would want to sort of bring it to your kind notice that Apex operating cost is one of the lowest in the industry, including the employee cost. And but coming to the specific in terms of an increase, in the first half year of this year versus last year, as I mentioned a little while ago, the last year first half 6 months, not really 6 months, it's only 5 months, because April 21 was fully closed, and our employee cost, not the fixed employee cost, but the variable employee cost and other related expenses was lower. So that's one aspect. But other significant aspect is that in the current year we had a 69% increase in our volume of disbursements. We have disbursed about 1,200 crores as against about 700 crores also in the previous 6 months. Now, as part of our employment remuneration terms, a part of the employment cost is a variable component of the employee cost, incentives, variable cost. That to move in line with the increase in volume. So because to reflect the increase in volume, part of, that's also one element of increase in the employee cost. Otherwise, there is no, actually there is no one time or there is no unusual cost that has been incurred.
But just to add, you had asked about the sequential growth, right? From 22 crores to 33 crores. Yeah, I'm coming to that. See, what has happened in the first quarter, our appraisal cycle is from May to April. So in April, the cost that would have got booked will be low, and May and June will be slightly higher because of the increments that has been given. But for the quarter ended September, it will be at the higher cost. That is one thing which has contributed to this. Plus, the other one is as Mr. Anandan told, it is basically the incentive payouts because of the increase in the volumes of business. So these are the two things which has contributed to this increase.
Even if I take these two, situations into consideration, one being the revision of pay probably coming only in 2 months for last quarter and 3 months for this quarter, and even if I take into consideration the jump in disbursements that we've seen, to a certain extent maybe explains the jump, but maybe I'll take it offline in more detail.
We take the offline, we can work out the details and show it to you.
No problem, sir. No problem. So second question is, if I look at our NBFC AUM, which typically books the business loans that we do, that growth has lagged the home loan or core home loan growth. Whether this is
it's very much true. There's a conscious decision by us in terms of, particularly given the COVID impact and the behavior of the customers in terms of repayment, credit risk and things like that, caused by the post-COVID scenario. We were wanting to be very careful in lending to that segment, till things come back to the normalcy. So to that extent, we have tightened our credit process, sanctioning and disbursement process. And we would want, because when we looked at the whole data, the customer behavior data in terms of repayment, NACH clearance, repayment, NPAs, etc., in every detail, we found the profile of the SME customers are slightly lower than the profile of the home loan customers, and largely caused by the impact on account of post-COVID situation. So we were a bit conscious, careful in lending that segment. But now we are finding that it's coming back to normal. So we have started restoring it back to our value lending levels.
Yeah. So actually, the question that I was trying to get at was that, uh, uh, like you mentioned right now, that we are seeing an improvement in the profile or in improvement in the situation of these SME customers. By when should we expect this growth to sort of either come closer to or match or even surpass NBFC or the housing finance AUM growth?
Even in this quarter, from this quarter onwards, we are trying to restore it back to the normal levels. Yeah, pre-COVID levels. Yes.
Right. And just one request, if you could break down the disbursements, between the housing finance and the business loan segment, that will be very helpful.
We'll do from the next quarter onwards. We'll start doing that.
Not a problem.
Sure, sir. Thank you so much. I'll get back in just a minute.
Thank you. We have the next question from the line of Nischint Savati from Kotak Securities. Please go ahead.
Yeah. Thanks for taking my question. A couple of questions. One is on stage 2 loans. Do you think that this is a normalized stage 2 loans, or do you think that there is still some scope for improvement?
Stage 2, we would want to improve it further to pre-COVID levels of at least 4.7%. Actually, that's the focus with which we are functioning, and that's why we brought it down from 9.91 to 6.48 as of June, and then to 6.32 as of September. The efforts are on, but it might take another 1 or 2 quarters to come back to that level.
Sure. The other question is, really on attrition rates that you would have seen in your home markets. Have you seen any change over the last 12 months?
Actually, it's just not the last 12 months. If you really look at we have looked at the data for the last 5 years, it is about the same level. And there is some minor movement happening slightly upwards. But then that's, let's say on 8%, it is some 8.1, 8.2, that kind of thing. But broadly, the pre-closures around 8%.
He's asking about attrition.
Okay. Yeah. Oh, sorry, I missed the point. And the attrition, as far as we look at the entire, human HR in 3 segments. The what we call senior most at the MC level, it is 0 attrition, and at the middle management, which really comprising all our area managers, cluster managers, and the assistant AVPs and things like that, the attrition is only around 4 to 5%. But our attrition is really slightly large at the 3rd segment, what we call band 3, which is really at the sales officers, of the 2,500, 600 staff, closer to about, 2,000 people are employed in the branches, 1,000 in terms of sales officers, and about 400 in collection, and the balance in legal, technical, credit, etc. at the branch level. There, again, the attrition is low in support functions like legal, technical, credit, and all. But the attrition, in fact, even collections also it is low. But the attrition at the sales officer level of 1,000 is high. It's around 20%. That's what we are trying to work out, how to really improve on that.
And have you seen a change over the last 12 months? I think that's what I was looking at.
Change, actually, it's sort of improving. It used to be around 25. In fact, it has coming down a bit because basically there is we have introduced system to what we call, if they served a minimum of 6 months, minimum of 12 years, we will pay them one time, sort of bonus kind of thing. That seems to be helping us in a way. So in other words, those staff who completed a pretty certain period of time, and also put in the files, record files, they will be given, in addition to their salary and whatever it is, they will be given a sort of additional bonus. That's only one time, but that seems to be working because we saw through our analysis that a lot of this attrition used to happen or happening of those employees who've been serving for less than 6 months, and it comes down as they are for a longer period in the company.
Sure, got it. And just one last final question is, typically when, economy slows down, many of the self-employed borrowers who are kind of, borrowing at a slightly higher, sort of, 15% plus rate of interest, tend to prepay their loans because, their businesses are probably not, yielding them as much. Have you seen a similar trend, when economy actually slows down?
Actually, you are right. Looking at the overall economy, yes, the inflation is hitting and the money left in the hands for making these kind of obligations, after meeting the regular expenses less. So it is bad for overall economy, right? But what we are really seeing that in the affordable housing finance segment, where the loan size is small, the EMI size is small, the net increase in the EMI itself is very, very limited. And that in our case, 80% of the cases, the customers are staying, in these properties themselves. It is in Tier 3, Tier 4 cities. And also these customers, most of our customers, they are in the service businesses. Though the inflation is very high, interest rates are also high, but they are able to quickly correct. Instead of selling a unit of whatever they are doing for 5 rupees, if they sell it for 6 rupees, that is covered for them. So in other words, because of the small size of the loan, small size of the EMI, and the fact they are occupying there, we are not, seeing that as a negative factor, either in repayment or in demand of fresh loans. Both.
Sure, got it. Thank you very much and all the best.
Yeah, thanks.
Thank you. We have the next question from the line of Amit Bhatt from MIT Engineers. Please go ahead.
Sir, congratulations for your great performance in disbursement front in the first half. Sir, my first question is, can you please throw some lights on disbursement in the festive season, which is almost zero COVID festive season after 2 years gap? And the second one is, your competitors like 5-Star, they are more aggressive in opening new branches and hiring staff. So how your company is going to maintain the AUM growth, the same AUM growth in the coming quarters?
So first of all, I don't know where you got the idea that our competitor is 5-Star. Because 5-Star is an NBFC, largely small SME loans, and in a loan range of 1 to 5 lakhs, average loan up to 3 lakhs. And they are, an NBFC doing the that kind of thing. We are largely a housing finance company, giving loans largely for the home loans. So we are not same. They are different. Okay, 5-Star can be compared with other NBFCs like Vistar, Veritas, part of Shriram, or part of etc. They are different segments. They are different segments. That's one aspect. Second aspect is really, as far as again, pretty well that the demand for home and the home loan is very significant, very large in the lower and middle income population, particularly in Tier 3, Tier 4 cities, particularly from customers who are self-employed, hence they don't have any readily verifiable income documentation. But on the core level, the demand for lack of homes or need for home loans are more, in this customer segment, the pie is very large and the penetration is very low. And because of that, I think, you must have seen the data, I'm sure, that the growth rate of not only Aptus, but the growth rate of all affordable housing companies is much higher than the growth rate of the formal housing finance companies' data. So, in other words, the formal housing companies are growing around 10-12%. Home loan, affordable housing companies are growing much higher than that. And that will continue for many, many years to come because the pie is very large and the penetration is very low. So competition per se, it will come, but one has to go some more time on that.
And sir, another question which you missed out, can you please throw some lights on disbursement in this festive season, sir, which is, first season after 2 years of zero COVID?
Actually, as we have seen that we are given that 69% growth in disbursements compared to the previous year, It was the first quarter, of current year has grown, and the second quarter, which is largely including the festival season of, September, October gets reflected in October, but we've had a good growth, demand coming on account of, in the festival season. But then, you also know that the festival season was there last year as well. So we are really talking about, net to net, yes, but despite that, we have really, our disbursements are higher. It's not because of the festival alone, but the other factors also in terms of, larger number of branches, higher number of sales staff, and our ability to generate more online, offline inquiries and things like that.
Okay, thank you, sir.
Yes.
Thank you. We have the next question from the line of Franklin Moraz from Equentis Wealth Advisory. Please go ahead.
Yeah, sir. Thanks for taking my question. So what would be your incremental cost of borrowings?
Yeah. Not able to hear you.
Yeah, sir. Can you hear me?
Yes.
Yeah. So I wanted to know what is your incremental cost of borrowings?
Okay. This quarter, we have raised almost 800 crores from banks. That is at the rate of around 7.5% to 7.7%. So that is the incremental cost. And plus, there will be some processing fees that was paid around 0.25 to 0.5%. So that's the incremental cost.
So, sir, if I have to just understand, post your rating upgrade, what is the kind of cost benefit that you are seeing?
Yeah, actually, earlier we used to get funds at around 8.25. Now it is around 7.5 to 7.7%. And there have been some banks which is giving at the MCLR rate itself without any spread. So that is the kind of confidence that is getting reposed by these banks on the company because of the rating upgrade.
Okay. And would it be fair to assume, assuming there is no further, RBI rate hike, that, it would take about 1 year for this entire rate to pass on?
Yes. What is happening is currently we are having this 1,000 crores of fund. Plus the bank borrowings which are linked to this MCLR, which is 1 year MCLR, there can be increase. Some increase can come in Q3 and also in Q4, but that will be offset by the lower cost of borrowings which we will be drawing from NHB. So if you compare that, I think the cost of funds will more or less remain the same at 7.7% for the entire year.
Okay. And is there any scope for increasing, your yields from current levels, just in case, rates go up further and the cost of funds, increase?
Definitely, we can. There's nothing in the sense that on variable contracts, we can increase. And on fixed contracts also, in exceptional situations like this, we have the right to increase. But we will also look at, how best we can support our customers in these times, in these difficult times. And given our financial metrics, we said we will look at any increase in our EMI only as a very, very last resort.
Okay.
But we would really want to first improve the operations through productivity, cost control, and better way of doing things, and reduce our NPA, NPA and the credit costs and things like that, and thereby continue to deliver good ROE to the shareholders, and look for minimum increase to the customers.
On the 22% floating book on your loans, what are the components over there?
Components mean?
As in, what comprises the floating piece on your loan book?
See, out of the total loan book of 5,932 crores, 22% is linked to the variable rates, where we have scope to increase the rates. Does that answer the question, or you want something? I was
trying to understand, is the product different in a fixed rate versus a floating rate? Are you offering some different product, or is it the same product?
It's basically the housing loans which has been offered at the variable rate. The quasi home loans and the small business loans are at fixed rates of interest.
Okay. So my last question is, what is the tenure on an average for your lending piece?
We lend up to 15 years for the housing loan and 10 years for the quasi home loans and 7 years for the small business loans.
Okay, and I mean at end to end, how long does the borrower take to repay on an average?
Average for the housing loan it is around 10 years, and for the quasi home loans it should be around 8 years, and for the small business loans it's around 5 years.
Okay, sir. That's it from me. Thanks a lot.
Yeah.
Thank you. A reminder to all the participants, kindly limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Manoj Oberoi from Yes Securities. Please go ahead.
Yeah, sir, this is Rajiv. Can you hear me?
Yeah, Rajiv.
Yeah. So, sir, my question is on asset quality. So, when I look at the gross NPLs, we have seen a significant reduction in this quarter. So, firstly, this reduction, I presume, is as per, it is full normalization or recoveries, right? Because we report gross, correct?
No. What was the question? I didn't get you.
So, the question is the reduction in NPLs that we are seeing in the quarter, it is basically either full normalization through collection or it's a recovery in NPL, which we have kind of pursued and got it.
It is NPA recovered.
Okay. No, because when I was looking at, while we are showing very good recovery in the NPL buckets, there is also increase in stage 2 coming from stage 1 or maybe from the zero DBT portfolio.
That the percentage that has increased in the stage 2 and the percentage that has decreased in the stage 3 is there. Because under the new RBI guidelines, what happens is if the NPA has to go out of NPA, it has to be fully collected or it has to be settled by the customer.
Correct.
Yeah.
So that is what we are following, right? So when we show NPA reduction, it is a full
following the revised RBI guidelines clearly.
Correct. No, so my question is, while the NPL bucket is recovering, we are getting good recoveries and we are getting full collections and full normalizations out there. Why do we see, slippages into stage 2, meaning that an already fine customer slipping into the next bucket? Why do we have two kinds of movement?
Small slippage of 0.25%, but that will get collected in the next 2 quarters. I mean, that will be focused, and then, as I told you, our focus is to bring the stage 2 to 4.7%. So that's the objective with which we are functioning.
Okay. And sir, Telangana and AP has been driving significant growth for us over the last many quarters now. Can you kind of point out which markets and locations in AP and Telangana are driving the growth, and what will be our market share in the target customer segment?
Actually, we don't want to get into, very specifically but then by and large, we would put it this way. The growth that we are getting is really largely through the increase in the productivity of the existing branches. We have got about 215, 213 branches. These are again growth coming through largely the increase in productivity of the our sales officers, on-field sales officers. And if you really look at it geographically, the growth is coming more in certain states like Andhra Pradesh, Telangana, and Tamil Nadu, and maybe less in some states like in states like Karnataka. That's broad, and the growth is largely coming on the HL because we have taken a conscious call to go slow on the SME business, which we are restoring now.
Okay. This last follow-up, I mean, can we get the name of top 5 cities or markets in terms of concentration?
I think we will take it offline.
Sure. Thank you.
Thank you. We have the next question from the line of Maruk Adadania from Nuvama Wealth Management. Please go ahead.
Yeah, hello, sir. Good afternoon. So my first question is whether you would like to maintain your stage 3 CL cover at 25%. So will that remain at that level now?
Yes, the provision coverage ratio on the NPA, we would like to maintain at around 25%.
Okay.
Now, also to add, we have also taken a decision that any NPA beyond 24 months, we will write them off fully. So, in other words, our the philosophy is that anything above 24 months will be fully written off. Of course, the recovery effort will continue to be there, but then as a policy decision, we said anything over 24 months will be 100% written off. Then the NPA between 91 to 24 months, what we call NPA, we have decided to carry this 25%, right through. Okay. And in the overall terms, we have, decided to have an overall provision of 1% of the total loan book. If our loan book is about 5,900 crore, 1% of that, we have decided to carry. So that 1% also will continue. This is a policy that the board has adopted, and that's what will be practiced going forward.
Got it, sir. Very clear. And so my other question, I have two other questions. One is on margins. So you are expecting, not margins, but spreads. You are expecting spreads to now remain stable given the offset of higher bank borrowing costs with NHB. So margins will remain stable, right?
Margins will remain stable. As I told you earlier in one of the responses, see, if you look at my cost of funds, it is at 7.7%, and the yield we are very comfortable, able to maintain at around 17%. And this cost of funds is likely to remain the same for the next 6 months or maybe for 9 months as well. So we will be able to maintain this spreads or the NIMs, and this will continue.
No, unless, caveat, unless there is substantially higher increase in interest rates than what has been generally understood by all of us today.
As of now.
As of now. Something crazy happens and the interest rate is going to be totally way off. Then it is an extra thing which all of us have to face.
Correct.
Yeah. Got it, sir. So, and my last question is that how have you seen the demand behaving in October, November?
No, we don't actually. We see the demand being intact, and we see good demand. Given the fact that we are, our customer profiles are, as I again mentioned that it is really in, lower and middle income, self-employed, Tier 3 type cities, small home loans, and largely for self-construction, which are largely occupied by them. And this is, the penetration in this market is very, very low, while the overall mortgage penetration is around 10 to 12%. But within the affordable housing, within this segment, the penetration even is much lower actually. Because of the home loans reach for Tier 3, Tier 4 cities, smaller home loans are even much lower. So in other words, that way the macro scenario if you look at, we expect the demand to be continue to be robust for many years to come.
Got it, sir. So, and just one small clarification on this quasi home loans. Why is the duration lower? So, is the product structured differently from normal home loans?
Why is it a 10 years?
See, basically, see, the question is that there are, refinance guidelines being different for the home loans and on the non-home loans. The non-home loans are treated as a normal loans. And from the ALM point of view, we thought the prudent decision for the, for the home loans to have a much longer duration than the, non-home loans.
Okay, sir. Thank you.
Thank you.
Thank you. We have the next question from the line of Ankit Bansal from AB Investment. Please go ahead.
Hello.
Yes, Ankit.
Hanji, sir, my question is, sir, with this kind of pace you are growing, what are your future? Where are you seeing yourself? How are you placing your disbursement? How are you placing your growth? What customers are you targeting in next 5 years or 10 years? What level of growth are you expecting in next 5 or 10 years?
Yeah, Ankit, see, the question is that fundamentally, basically, our customer profile will continue to be so. Because we are quite happy with this kind of customer profile, and which needs, of course, a lot of the ability to underwrite, the ability to collect are challenges. But having said that, this is a large customer, underserved, unserved. So fundamentally, we may not look at different types of customers in terms of larger size, formal, wholesale, corporate. We will not look at that all. So we will continue, our strategy focus will continue to be in the same class of customers. And given these customers who are located largely in Tier 3, Tier 4 cities, the growth will, we would want to be near, and the fact that we wanted to be nearer to the customers in terms of collections and risk management and further demand, to meet the further demand, we will continue to have the branch additions as relevant and appropriate. We will not really go overboard on the branch additions also, but we'll continue to keep adding enough branches to be able to support the growth. So in other words, as far as the objective, the core objective of the company is that we would want to really look at a growth rate of at least twice the market growth rate. Just to explain, if our formal home loan market is growing at 10%, we would want to grow at 20%. If the affordable housing is growing at around 15%, we would want to grow at around anything between 25 to 30%. And that is our philosophy. And again, we don't want to grow for 100% growth, 50% growth, 200% growth and all. We would want to go for a consistent growth over a long period of time with good quality assets without compromising on our financial metrics, which has to reflect the risks that we are underwriting.
Okay, sir. My last one is, you are using AI technology for all this in your business. So what upgradations are you doing to keep in day-to-day to present technology with your past technology? What upgradation will you make, changes will you make so that your technology will remain updated with the present time?
I think it's a very large question, Dinesh, but generally, we are really investing a lot of time, effort, money, people on the technology front, both in terms of acquisition, underwriting, verification of legal documents, collections, customer service, risk management, and not only in terms of doing more business, enabling the scaling up, same time, control the risk and provide highest level of service to our customers, because we do believe in repeat business, and we do get significant we do get some good repeat business as well. So in other words, areas in terms of enabling scaling up, enabling productivity, enabling cost control, enabling risk management, enabling customer service. And for that, we are really investing in technology, in every aspect, whatever the relevant technology is, whether it is our core loan processing, or loan management, or customer service, or employee management, or I think maybe Balaji can sit with you sometime offline and be separately.
Explain you maybe clearly. Yeah. But one thing is that ours is not a dated technology. Everything is relevant and everything is new. I mean, so there is no, as of now, there is no need for upgradation.
Okay, sir. Okay. Thank you, sir. Thank you.
Thank you. Ladies and gentlemen, that was the last question that the management could answer today. I would now like to hand the conference over to Ms. Mona Ketan for closing comments. Over to you, Mona.
Yeah, hi sir. I just have two quick clarifications before we close the call. So the outstanding restructured book would be around 42 crore as of September. Is that a fair understanding?
Yes, it's 0.8% of the total area. Yes.
Sure. And where would our 1+ DPD be as of September end?
As of September, it was at around 8.75%.
Okay. So similar as June quarter.
Yeah.
Okay. Thank you, sir. Thank you, everyone, for joining us today. We thank the management for providing us this opportunity to host the call. Thank you very much. And so over to you for any closing comments you may have.
Yeah. Thank you, Michelle, Mona, for organizing this conference call. I would like to pay my sincere gratitude to all the analysts and investor friends who have taken time out of their busy schedule to listen to us today. Please feel free to connect with us in case you have any further queries. We would be happy to get back to you. Thank you.
Thank you.
Okay.
On behalf of Dolat Capital, that concludes this conference. Thank you for joining us, and you may now disconnect.